Preparing for a financial analyst at Charter interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. How would you approach building a financial forecast at Charter? I would begin by clarifying the decision the analysis supports, then gather reliable historical and operating data. I would build a driver-based forecast, test assumptions against prior performance and external benchmarks, and reconcile outputs to reported financials. Next, I would summarize the key variance, risks, and sensitivities in plain language. For Charter, that could mean connecting revenue to subscribers, pricing, product mix, and churn rather than treating growth as a single unsupported percentage. While answering, focus on clarifying the decision, gathering reliable data, identifying operational drivers, building linked schedules, testing assumptions, and communicating sensitivities rather than presenting unsupported top-line growth. Question 2. Which financial statements would you analyze first, and how do they connect? I usually start with the income statement to understand revenue, margins, and earnings drivers, then move to the balance sheet and cash flow statement. Net income flows into retained earnings, while non-cash items and working capital changes reconcile earnings to operating cash flow. Capital expenditures affect cash and fixed assets, and borrowings affect both debt balances and financing cash flow. Reviewing all three statements prevents me from mistaking accounting profit for sustainable cash generation. Make sure to cover the income statement, balance sheet, and cash flow statement, explain their links, and emphasize how working capital, capital expenditures, debt, and non-cash expenses affect financial analysis. Question 3. How would you analyze a revenue miss versus budget? I would first confirm that actual and budget data use consistent definitions and periods. Then I would decompose the miss into customer volume, price, product mix, timing, and any unusual items. For a subscription business, I would examine gross additions, churn, average revenue per user, and promotional activity. I would separate temporary timing effects from structural weakness, quantify the forecast impact, and recommend actions such as pricing changes, retention efforts, or revised sales assumptions. In your answer, talk about decomposing the variance into volume, price, mix, timing, and foreign exchange, validating data quality, identifying controllable causes, and recommending specific corrective actions. Question 4. What operational metrics would you monitor for a communications company like Charter? I would monitor broadband and video subscriber trends, gross additions, disconnects, churn, average revenue per user, penetration, and customer acquisition cost. I would also track service reliability, promotional discounts, labor productivity, and capital intensity. The important step is linking metrics to financial outcomes. Subscribers and pricing drive revenue, churn influences lifetime value, and network investment affects both customer retention and free cash flow. I would compare trends with budgets and relevant competitors. Be sure to mention subscriber additions and losses, churn, average revenue per user, broadband penetration, customer acquisition cost, retention, network investment, and how operating metrics translate into financial results. Question 5. Explain EBITDA and why analysts use it. EBITDA is earnings before interest, taxes, depreciation, and amortization. I use it as a rough measure of operating performance because it removes financing choices, tax structures, and certain non-cash charges, making comparisons easier. However, it is not cash flow. Businesses still require taxes, interest, working capital, and capital expenditures. I would therefore analyze EBITDA alongside free cash flow and leverage, especially in capital-intensive industries such as telecommunications. Focus on defining EBITDA, explaining its usefulness for operating comparisons, acknowledging exclusions and limitations, and distinguishing it from operating cash flow, free cash flow, and valuation metrics. Question 6. How do you calculate free cash flow, and why is it important? I generally calculate free cash flow as cash flow from operations minus capital expenditures. I would verify whether the company includes spectrum, restructuring, or other investment items in its reported definition. Free cash flow matters because it shows cash available after maintaining and expanding the asset base, which can fund debt repayment, dividends, buybacks, or acquisitions. For Charter, I would analyze both absolute free cash flow and conversion from EBITDA over time. Make sure to distinguish operating cash flow from free cash flow, identify capital expenditures and other adjustments, explain its importance for debt repayment and investment, and note company-specific definitions. Question 7. What is working capital, and how would you analyze a change in it? Operating working capital generally includes receivables, inventory, and other operating assets less payables and other operating liabilities. An increase usually consumes cash, while an increase in payables or deferred revenue can provide cash. I would compare balances with revenue or operating expenses, calculate days metrics, and investigate unusual movements. A receivables increase might signal slower collections, whereas higher deferred revenue may reflect stronger upfront billing. I would separate timing from sustainable improvement. In your answer, define operating working capital, discuss receivables, inventory, payables, and deferred revenue, explain cash flow effects, and distinguish sustainable improvements from temporary timing benefits. Question 8. How would you evaluate whether a cost reduction initiative is successful? I would establish a clearly defined baseline and identify the initiative's expected timing, ownership, and savings category. Then I would compare actual costs with an adjusted baseline that removes volume, inflation, mix, and timing effects. I would distinguish gross savings from implementation costs and confirm whether benefits recur. For Charter, I would also monitor customer service, network reliability, and churn, because cost reductions that damage service may destroy value elsewhere. Focus on establishing a baseline, separating savings from volume or timing effects, measuring realized versus planned benefits, considering service quality, and checking whether savings are recurring or one-time. Question 9. Walk me through a discounted cash flow valuation. I would forecast unlevered free cash flow, estimate a discount rate such as WACC, and discount each forecast period to present value. I would calculate terminal value using either a perpetuity growth method or an exit multiple, then discount it as well. Adding the two present values gives enterprise value, subtracting net debt produces equity value. I would sensitize revenue growth, margins, WACC, and terminal assumptions because valuation often depends heavily on them. Be sure to cover forecast free cash flow, discount rate, terminal value, present value, enterprise value, equity value, and sensitivity analysis, while explaining the major judgment areas. Question 10. How would you assess the quality of assumptions in a financial model? I would trace each major assumption to historical results, management guidance, operational data, or credible external benchmarks. I would check internal consistency, for example, subscriber growth should align with revenue, staffing, and capital requirements. I would compare assumptions with prior forecast accuracy and create base, upside, and downside cases. Finally, I would document the rationale, owner, and update frequency so another analyst can understand both the numbers and the judgment behind them. In your answer, discuss historical evidence, management guidance, market data, operational drivers, internal consistency, downside cases, and transparent documentation of judgmental assumptions. Question 11. What is the difference between a budget, forecast, and variance analysis? A budget is the approved financial plan for a defined period, usually established before the year begins. A forecast is the best current estimate of expected results and can change as conditions evolve. Variance analysis explains the difference between actual results and a budget or forecast. I see the three as complementary. The budget sets targets, the forecast supports decisions with updated information, and variance analysis identifies what changed and what management should do next. Make sure to distinguish the planned budget, updated forecast, and actual versus expectation analysis, and explain how each supports planning, accountability, and management decisions. Question 12. How would you explain a complex financial result to a non-finance executive? I would lead with the conclusion, quantify the impact, and explain the result through a small number of business drivers. Instead of saying margin declined because of unfavorable mix, I would explain that lower margin customer additions and promotional pricing reduced profit by a specific amount. I would use a bridge or chart, avoid unnecessary accounting terminology, and finish with the decision required, key risks, and whether the issue is temporary or likely to persist. Focus on leading with the conclusion, translating accounting language into business drivers, using a concise bridge, quantifying impact, and ending with implications, risks, and recommended action. Question 13. How do you ensure accuracy in an Excel financial model? I separate inputs, calculations, outputs, and supporting schedules, and I clearly label hard codes, formulas, and sources. I use checks for balance sheet integrity, cash roll forwards, sign conventions, and unexpected changes. I test key formulas independently, review outputs against historical results, and run sensitivities to expose fragile assumptions. Before delivery, I trace important cells, confirm source file versions, and ask another reviewer to challenge both the mechanics and the conclusions. Be sure to mention organized structure, source checks, formula consistency, balance checks, independent recalculation, sensitivity testing, version control, and review by another person. Question 14. Tell me about a time you found an error in financial analysis. In one forecasting exercise, I noticed that projected monthly revenue jumped despite flat customer counts. I traced the model and found that a pricing assumption had been applied twice in one schedule. I corrected the formula, recalculated the forecast, and notified the team before the analysis was circulated. I then added a reasonableness check comparing revenue per customer with historical ranges. The experience reinforced that strong controls combine formula review with business understanding. In your answer, use a concise situation action result structure, explain how you detected the error, quantify its impact, describe the correction, and emphasize prevention rather than blame. Question 15. How would rising interest rates affect a highly leveraged company like Charter? Higher rates can increase interest expense on floating rate debt and raise the cost of refinancing maturities. That reduces free cash flow, potentially limits investment or shareholder returns, and can pressure leverage and covenant headroom. Higher discount rates may also lower enterprise value. I would review the debt maturity schedule, fixed versus floating exposure, hedges, liquidity, and sensitivity to rate changes. The effect depends on duration, refinancing timing, and the company's ability to pass through pricing. Focus on floating rate exposure, refinancing costs, interest expense, cash flow, valuation multiples, covenant headroom, hedging, and the difference between immediate and longer-term effects. Question 16. How would you compare Charter's performance with its competitors? I would begin by ensuring metrics are defined consistently across companies. Then I would compare subscriber growth, churn, pricing, revenue per customer, EBITDA margins, capital intensity, free cash flow conversion, and leverage. I would adjust for differences in geographic footprint, product mix, accounting treatment, and investment cycles. A useful comparison does not simply identify the highest margin, it explains whether performance reflects sustainable operating advantages, temporary underinvestment, customer mix, or different strategic priorities. Make sure to cover comparable definitions, growth, margins, churn, customer economics, capital intensity, leverage, and normalization for business mix, accounting policies, and market differences. Question 17. What would you do if management asked you to support an aggressive forecast? I would first understand the strategic rationale and identify which assumptions make the forecast aggressive. I would test those assumptions against historical performance, operational capacity, market data, and leading indicators. Rather than simply rejecting the request, I would present a base case, management case, and downside case with quantified implications. I would clearly label the assumptions and risks, document my analysis, and remain constructive while protecting the credibility of the forecast. Focus on professional skepticism, evidence-based assumptions, transparent scenario modeling, clear risks, respectful challenge, and preserving the distinction between management targets and an analyst's unbiased forecast. Question 18. How would you analyze a proposed capital investment in network infrastructure? I would estimate incremental subscribers, pricing, retention benefits, operating savings, construction costs, maintenance spending, and timing. I would convert those assumptions into incremental free cash flow and evaluate NPV, IRR, payback, and downside cases. I would also consider network reliability, competitive positioning, and regulatory requirements. A project can create value through avoided churn or lower service costs even when direct revenue is modest, but those benefits must be supported by measurable evidence. In your answer, discuss incremental revenue, operating savings, maintenance and expansion CapEx, customer retention, payback, NPV, IRR, scenario analysis, and strategic benefits that may not appear immediately. Question 19. What is the difference between enterprise value and equity value? Enterprise value represents the value of the operating business available to all capital providers. Equity value is the value attributable to common shareholders. The basic bridge is equity value equals enterprise value minus debt plus cash, with adjustments for items such as preferred stock, minority interests, or pension obligations when relevant. EBITDA multiples typically use enterprise value, while price to earnings uses equity value. Using the wrong denominator can make a valuation comparison materially misleading. Be sure to define both measures, explain the bridge using debt and cash, identify other adjustments where relevant, and connect the distinction to valuation multiples and transaction analysis. Question 20. Why do you want to be a financial analyst at Charter? I am attracted to Charter because the role combines rigorous financial analysis with a tangible operating business. Recurring subscription revenue, customer behavior, pricing, network investment, and leverage create meaningful analytical questions rather than purely mechanical reporting. I would bring strong Excel, accounting, and communication skills, while continuing to learn from experienced finance partners. I am especially motivated by producing analysis that helps leaders allocate capital, improve customer economics, and make better forward-looking decisions. In your answer, connect analytical skills with Charter's operating complexity, recurring revenue model, capital intensity, customer metrics, teamwork, and your interest in turning data into actionable business recommendations. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.